So we're absolutely delighted to have Paul Moroz here with us today. Paul Moroz is the Chief Investment Officer and a Director at Mower Investment Management, which he joined in 2004. As Chief Investment Officer, he has broad responsibility for the research and analysis of global equities and fixed income securities. He's also co-manager of the Mower Global Equity Strategy. Mr. Moroz was a joint recipient of Investment Executive's 2019 Fund Manager of the Year Award, and in 2013 won the prestigious Morningstar Foreign Equity Fund Manager of the Year at the 19th Annual Morningstar Awards. He was co-manager of the Mower Global Small Cap Fund from 2007 to 2020. From 2016 to 2017, Mr. Moroz relocated to Singapore and served as CEO and Director of Mower Investment Management, Singapore. Prior to joining Mower, Mr. Moroz was employed by Alberta Investment Management and Merrill Lynch, Canada. Thank you for joining us today, Mr. Moroz.
Thanks for having me.
Excellent. So let's dive into your intro.
Sure. So I thought what would be neat is getting a little bit philosophical about investing. So I wanted to start with a few quotes from a book that I think is pretty cool. Some of you out there may have read it, Hitchhiker's Guide to the Galaxy. And there's one quote which is really fun. One of the characters, I might mispronounce his name, Lunqual. They're trying to find the answer to the universe. And there's this realization after years, millions of years, this computer, Deep Thought, is working on the answer. And it's revealed that the answer is 42. And this character, Lunqual, says, 42? Is that all you have to show for 7.5 million years of work and calculations? And later on in the passage, Deep Thought responds, so when you understand what the question actually is, you'll know what the answer actually means. And I just want to reflect on that for a moment, because I think that's so powerful, not to assume that we know the answer, but to think a little bit harder at the real question at hand. And that might be not only true when thinking about investing, but maybe it can be applied to life in general. The way that it applies to investing, I think, when we think about value investing, often that might be the answer, the perceived answer. That might be 42 that Deep Thought leaves us with, but it's worth reflecting on, well, what's the actual question? What are we trying to do with that? And I believe that you can think about the question as in a few different ways. The first is, well, one, how can we make better investment decisions? And I think we can even modify that, because that's a subset of the question, just how can we make better decisions, period. And finally, I think we can apply a little more context around those decisions. How can we make better decisions given that we're faced with uncertainty in our world? When you reframe the question that way, that might be a little bit different. It might give you a little more context to think about just your style of investing or value investing. So here's where I wanted to go with this. I wanted to propose the first thing in thinking about answering that question as to the sort of the reason or the logic behind why we should be doing any of this. We're after this somehow, this mathematical property of compounding. Everyone at some point in their investment career has been exposed to the magic of compound interest, and at some point everyone has their own story about that aha moment. But that is the mathematical formula that we're actually after. But I think the trick is the way that you want to achieve that is very important. And the logic behind it relates to a concept that I've always found very fascinating, this concept of entropy. This idea that it's the second law of thermodynamics, is the idea that heat flows from hot to cold, not the reverse. The end state is that the heat is going to move in that direction. So there's lots of things that have this concept of entropy. You can think about what is the end state if you open up a bottle of perfume in a room, and eventually what happens? The molecules make their way out and sort of mixes with the air, and it disperses. That's entropy. Time is entropy. There's lots of things that are entropy. What plays out over time that ends in some sort of steady state? And I think that's a really powerful concept to think about investing. The purest form of investing, I believe, is when it sort of aligns with this concept of entropy, when just investing can be reduced purely to a function of time. You see that in the math of bonds. And it's not always that simple because there's so much uncertainty, but that's a really important concept. People often, and more recently, ask about cryptocurrency. And I think this concept of entropy and dividing out the difference between investing and speculation is really powerful, because you can apply that logic, that ultimate purpose for what you're doing, and recognize that if you invest in some sort of cryptocurrency, all that you'll have in 1 year is that same investment, whatever it is. Maybe it was 5 Dogecoin. And over the course of 2 years or 5 years or 10 years, all you will ever have is that same thing. And if we were 1,000 years in the future, your original purchase of Dogecoin, as it stands now, would just be those same things. There is no compounding function. There's no end state. There's no replication of the asset itself. So there's one concept, and that's kind of a why should we approach investing? What's the logic behind it? The second one is this idea that we're actually after knowledge, but knowledge is very fragile. And to help us with that, when we think of investing, you need frameworks to guide you and differentiate, what represents better knowledge, what the truth is. And actually, value investing, that's a framework. All the stuff that Ben Graham did, and all the balance sheet work and peer analysis, if you go back to the book Security Analysis, these were frameworks for how to make better decisions. But it's only one framework. Remember, he wrote that coming out of kind of that era of the Depression. The economy was different then. That's one framework for how to approach the world. But there's others, right? Thinking about business models. What makes a better business model? Maybe one that requires less capital, all else equal, or companies where they get paid more at the beginning, or business models where they don't need to compete on risk. That's more attractive than ones that do. So the business model, I think, would be a good way to think about it. But it's a framework. It doesn't give us the answer, but it helps us guide through this void where we're seeking knowledge. Management teams is another. Just this concept that you're not investing in simply a financial ticker that moves around. For anyone out there that has done the work of incorporated their own people, hired their own people, delivered flyers to advertise, all those decisions are made by people, and you can make a wide variety of decisions. As everyone has friends that you may question their judgment, and you have friends that have really good judgment, and there's lots of people that we know there is goodish and baddish decision-making behavior. So management becomes another framework to understand kind of the truth. And valuation is another concept. Same thing. When we look at discounted cash flow models, we're dealing with uncertainty. We actually don't know the answer. We can't pinpoint this concept of intrinsic value, but it helps us sort through the world and gets us a little bit closer to knowledge. So remember, knowledge is fragile, and still we need mental models and frameworks to help us with that. as we think about investing. Maybe the third point along here in making decisions would be you make better decisions with proper context. And context is rooted in understanding something in context of history, in context of the rest of the market, public securities versus private securities, in context of inflation. There's lots of context that you can get. You can think of depth and breadth. You're always comparing something. And when you think about investing, you got to ask yourself, well, why is this better? Why is this statistically significant in context of something else? And if it's not statistically significant, you have to go back to this concept of fragility of knowledge and ask yourself, am I really making a decision that's that much better off, or am I wasting my time? And then maybe the last one, as we think about decisions, we have to recognize how valuable we are as humans. And so much of decision-making should actually be in protecting us against ourselves and mitigating error of those decisions. I mean, just imagine the decisions that we made as a child, and you grow up and you grow up and you have more experience in this world, and you think back to the decisions you made 10 years ago or then 5 years ago. You gain more and more context, and you learn more and more, and you realize how little you know and how many errors you made. And there's tons of ways to make errors. So some of the things that I think you have to add for decision making, and again, it's not specific to the stock market or making investments. It's a question of how do we avoid and mitigate behavioral errors? How can we train ourselves to be thoughtful and flexible, consider different points of view, work with people to share different perspectives, mitigate or eliminate home biases, avoiding things like loss aversion, all that stuff that Kamen and Tversky wrote about. I mean, that's really powerful. So that's the fourth category that I have in thinking about decision making. So, back to the answer. When we think about investing, there's a lot of books where it presents you with the answer, and I'm really challenging everyone to think about the question behind it as you embark on your path and investment journey. I'll turn it back to you.
Yeah, that sounds excellent, and thank you for that presentation. It's definitely was one of the most unique presentations we've had, and extremely valuable, of course. We talked a little bit about valuation models before. You have some holdings that maybe you wouldn't traditionally think of as, let's say, value investor holdings, things like, let's say, Shopify, Amazon, Alphabet, Microsoft. How are you, let's say, can you walk us through, how are you valuing those companies? Is it, we know that some sort of managers who hold those types of holdings are, let's say, looking at it on a division by division basis, and sort of taking out the divisions that have negative earnings within some of those companies. Some of them are looking at it on more of, let's say, a subscriber basis. Can you talk about how you value those types of companies?
Absolutely. The first comment is that even the concept of being a value investor is a bit superfluous, because everyone's searching for value. If you're not searching for value, what are you doing out there? I think everyone's a fundamental investor, and maybe what you're relating, or your thought on the question is, there is investing that focuses more on growth, and there's investing that focuses more on the asset or businesses that are more mature. And there's a balance, because I'm not convinced that, depending on the scenario that gets played out in the universe, that you'll know which route leads you to a better margin of safety. One of the challenges that has occurred is this development of the internet, which has been amazing. I mean, just think for a moment that all these businesses, kind of technology companies, have been developed where often the business model doesn't require a lot of capital. Compare that to what went on in the Industrial Revolution, where you'd buy land and you'd build factories, and these were capital intensive businesses. It's people, it's knowledge, it's IT. So that's a little bit different. How do you deal with that with valuation? These businesses often scale up very quickly, not only because you don't need capital, but the incremental margins are very high. If you and I start a software company together, or a video game company, let's do video games, and we build our one copy, once we've done that, you can keep on selling that, and your drop-through margin, your incremental margin is very high. And then, and this is crazy to put this into perspective. Think about how business used the concept of distribution for business in the past. I mean, my very first business was cutting people's lawns, and we would physically go around and drop off a flyer in people's doors. And we thought, you know, if we drop off 1,000 flyers, maybe 10 people would phone us to cut our lawns. That was our distribution method. That wasn't very exciting. Now think about the prospect of accessing the internet. Even our conversation today in terms of distribution, there's the possibility that there could be, you know, hundreds or thousands of people that see this. It just scales. And so this concept of these businesses that can all of a sudden connect to millions, perhaps billions of people, that's something that we just previously haven't seen in the economy. So how do you deal with that with valuation? You have to try to compare what are really apples and oranges, and we do that through discounted cash flow models. You have to take an estimate of what you think this business could be growing at, and just as you're handicapping, you know, the riskiness of growth with growth companies, you also have to handicap with these mature businesses the risk that they're going to get disrupted and something goes wrong. So that's the way that we approach it, is through valuation. Growth investing is here to stay because of these new businesses, and that there's going to be lots of wealth created there. And it makes it even more difficult because many of these businesses invest through their income statement. And it's sort of backwards. If you think back in financial history, imagine before the accounting standards of depreciation. What you had is companies that would build their factory, and you know, at some point depreciation wasn't even invented yet. And at some point, and I don't know the story, someone else could fill this in, but someone came along and said, you know what, we're using the factory up, we're using this machine up, even though we're not spending more money on it, you know, today, there kind of has to be a matching principle, because we're going to eventually require this stuff to be replaced. So you had depreciation that was effectively invented, and you had to adjust your earnings that way. Well, now what's happened is almost the other way around, because it's the same matching principle, but lots of companies are spending money to build things and promote their products that actually will have an economic benefit far into the future, but that's all expensed right away. So the trick becomes, well, how do you deal with that? How much of that is actually real? How much is smoke and mirrors? This is no easy question, but what the puzzle with that from an accounting standard is, as soon as you start adding that stuff back, it's not making things more conservative like it did with depreciation. It's kind of almost reverse depreciation, if you're to think about it that way. If you capitalize it and remove the expense, add some amortization or depreciation of that intangible on it, it reverses the process. It's more aggressive, and the result could be room for manipulation. But that's just economically what you have to do. You have to think about it that way. So in a nutshell, this is what's happened, and this is why this concept of growth versus value, it's so tricky, and it's not going away. Your kids are, university students are going to be asking these questions for years. How do you deal with this problem?
Yeah, absolutely. That's very interesting. Thank you for your comments on that. You have some holdings in the energy sector, like Canadian Natural Resources and Suncor Energy, for example. Maybe talk to us a little bit about those, or about the energy sector in general and your view on it right now.
That's another one that's changing rapidly. Our world is evolving, and it's been a puzzle because there has been underinvestment in oil and gas for a very long period of time now. Since the kind of oil blew up and you had a shale oil revolution in the United States, and that sort of waned. Then you had COVID, things just stopped, CapEx stopped, and you've also had this theme of what sort of off balance sheet liabilities do these companies really have? You have a lot of ESG pressure, environment, social governance, but it's on the environmental side that is influencing how much capital can go back into the industry. So there's a number of factors here, but now as economies around the world have started to normalize, and we've seen such an underinvestment in some of these oil and gas companies, you've seen a price response, and it hasn't been matched right now with the same sort of CapEx response that you would have normally seen in the past. So the puzzle is, how long does this go on? Is there, is the ESG factor significant enough to dissuade others for investing more in this? Or is it the case that there's more environmental liabilities that, they're just not being discounted properly? In Europe, there's tax about, a windfall tax on some of the oil and gas companies. So this is, certainly it's not clear what the ultimate outcome will be. There's some wonderful tailwinds in the industry, but there's also lots of risks, and it will remain cyclical. And frankly, because it's a commodity, the level of wealth creation will be capped out just because of its industry structure. So don't forget about that.
Yeah, that makes a lot of sense. Thank you. And then one of your recent, I think it was a quarterly report, it might have been your annual report, you discussed sort of 4 different segments of companies that you had at that point, which were Chinese companies. One of them were after-school tutoring companies that were for-profit education. The second was internet and platform e-commerce, such as Alibaba or Vipshop. The third was gaming, such as Tencent and NetEase. And the fourth were liquor manufacturers, such as Itai. Can you discuss sort of how you see, obviously there's a lot of panic about investing in China right now for different reasons. How do you sort of see the future of each of those industries in China going forward?
It's difficult to know for sure, because China's a country where there's significant regulation and control from the government. And the way that we think about that risk is there's just more, we call it stroke of the pen risk, where someone can sign a bill into effect and that has immediate and drastic consequences. We saw that with education. But I think the recent actions of the government suggests that in some places, there is a little bit more risk. And the game plan with China for some time has been sort of to build up wealth, but always with this common prosperity idea in mind. It's just happened to be played out now. So, the question for investors is, how is this priced in the securities? And, again, this is a puzzle, because I don't think you can even put odds around this. We're dealing with uncertainty. The Chinese may, do something with the liquor market. Tencent, if you think about video games, I mean, their strategy as a business has been to say, you know what, in order to manage that uncertainty, we're just going to continue to expand into other parts of the world to manage that out. So, diversification and trying to build your portfolio, whether at the company level or a stock portfolio level, building things so that it's more resilient, that's going to be the hallmark of I think, a prudent policy to deal with this type of uncertainty, because you won't be able to predict it.
Yeah, absolutely. That makes a lot of sense. And also, you have some investments in companies in Japan. How is investing in Japan different from, let's say, investing in the United States, would you say?
That's a big question. And it's a question, I think culturally, if anyone who's listening to this has spent time in Japan. Japan is just so culturally unique. And I think all cultures evolve. What I would say about comparing and contrasting Japan versus the United States is the Japanese have very much a culture of putting employees at a very high level, probably ahead of shareholders in most cultures. That's the most important, just social element, is that that they're doing well for employees. In the States, for a long period of time, for many companies, and again, I'm generalizing, it's not the case for every company, but the profit motive of the companies was certainly in favor of the shareholder. Even in the United States, we think about fiduciary duty from a director standpoint, legally, culturally, like it's the shareholder that's being placed very high in that. So I think that's the one thing I would point to in understanding cultural differences in investing between the two places. I also think, there can be some really cool structural things that set up culture for a country. One of the things that's always fascinated me about the United States is how in the Constitution, it's sort of written in there, this concept of patent laws and protecting intellectual property and the kind of the ability to benefit from that financially for a while. That's really powerful. And I think, culturally, there's a reason that Silicon Valley is in the United States and not in Japan or not in other places. That innovation, that's a cultural thing. And that I think is one of the things that I've learned about in spending time in many different countries, how important business culture is to economic returns over the long term. It'll continue to evolve, but the United States is certainly a place that I think has lots of innovation. It's not without its challenges as a country, always working hard on that, but that's certainly an area where I think they'll continue to do well for shareholders for a long period of time.
Yeah, thank you for your commentary on that. That's very intriguing. And we know that a lot of funds who, just especially like a lot of value investment funds, they just, flat out just don't look at like pharma, don't look at biotech. They say it's like out of their circle of competence. That's clearly not the case with Mower. Can you discuss sort of how can students become, more comfortable with investing in pharma and make that more of their part of their circle of competence?
Well, I mean, pharma is a very, I call it a broad topic. I think you can still focus on elements that make business models better or worse. And a lot of the pharma that we focused on is where maybe the company is structured such that you think it has an edge in research, R&D. It may have an edge in terms of just the difficulty with how to produce, a pharmaceutical. There's a big difference between small molecules and large molecules, although, it's become with technology and biosimilars, that's become a little bit more competitive. People can always twist their business models to focus on different elements. So, for a while, and we were pretty early in this, recognizing that some companies said, we're not going to focus on as much on R&D. Actually, what we're going to focus on is distribution, and we'll just in-license drugs. These drugs might even be off patent, and we're going to think about, these little niches that maybe are a little bit more protective in terms of competition, and understanding also as well drugs that might not have as much scrutiny in terms of competition or pricing. A lot of times you get on a list, and depending on the country, there's more or less pressure in terms of pricing. So I think my advice overall would be, you have to break the business model apart and recognize that it might not be perfect, but you can find places where entrepreneurs have tweaked the business model. And again, just in developing that context, you might find an edge. And it might be a small edge, but over time, if you do that on a repeated basis, you'll improve your results.
Yeah, absolutely. And another question we had here is, do you use either, let's say, quantitative stock screeners at all, or also like keyword screeners that search through filings of companies?
Well, we use both, all of the above and more. I would suggest that a lot of the quantitative stuff, that's easiest to pick up and try to understand. So the tougher things are when you're using your own human intelligence, and we call it brute force screening. We'll spend a lot of time understanding what a company's about, and there will be certain characteristics that we're looking at that might give us clues as to why something is wealth creating, or why that might be changing, why a company has a growing tailwind. And it's through our conversation with management teams that we can expand on that knowledge. I think anytime that you're more creative, you're going to tend to get a better result. And anytime where your process is more commoditized, it might be more difficult to find an edge.
Yeah, absolutely. That makes a lot of sense. And one of the industries that I think some of the investing clubs, let's say at Brown, and I've seen some other ones at other colleges, that tends to pop up less is insurance. And I think that's because insurance may be more complex for people to analyze than other industries. Any advice for students on how to make insurance a bigger part of their circle of competence? We know that, for example, Mower has holdings of Aon and also Marsh & McLennan.
Well, the first trick to understanding Aon and Marsh McLennan is, while they're involved in insurance, they don't have any balance sheet risk. They're not insurance companies in terms of writing the policies out themselves. They are the brokers that are the agents for the insurance companies. And so, you know, there can be things that happen. Both companies, you know, have a history of, I guess what I'm saying is it's not flawless, but you've taken out so much risk by not having that balance sheet risk yourself. You've taken capital out of the business model, and for the most part, it's a pretty powerful part of the value chain. If you've ever gone through one of these insurance policies that Aon would put together for its clients, and we use Aon at our company, so I've seen these things. There's a lot of complexity. It's difficult to, it's not fungible, it's difficult to replicate. It's not something that it can be just sold on the internet. So a lot of what they're dealing with is larger companies that have complex needs. Take cyber security insurance in that part of your business, for an example. I mean, this is highly complex. So there's lots of virtues to the business model, just including the benefit of, you know, the insurance industry has been in a hard market, but imagine a scenario where there is more inflation and you're going to benefit from writing policies on more risk. If there's more inflation, there's risk is growing, and you get to capture that growth in a very low risk manner. So I think that's, again, the secret is think about the value chain. What are the best parts of the value chain? And for fun, any value chain, any industry, think about, you know, what are the weak parts to this? What are the good parts? How could you cut out or restructure that value chain to make it a more attractive business? I think that would drastically help people in understanding where they should be allocating their time and attention.
Yeah, absolutely. And can you discuss, as well as maybe as a case study, one of your biggest investment successes and one of your biggest, let's say, investment failures, and just, you know, your thesis on those and how you found those investments originally?
Well, I mean, one of the biggest successes that we've been a part of was Constellation Software in Canada, which has become more of a household name. But the concept was really simple. When Mark Leonard was taking the company public, he believed that you could invest in these software verticals where the software companies had pretty good switching costs for the most part. A lot of this was industrial stuff. It was little niches, and you could acquire them in attractive valuations. Remember, this is post technology crash, and then implement management policies that helped appropriately bring these companies up to better profitability. The focus was on capital allocation and really good management practices, and the competitive advantages have held together, and that's been a remarkable story in terms of compounding. I think some of my lesson in things that have worked out are that it doesn't have to be super difficult. Some of the best ideas in terms of compounding should actually take the least time and attention. If you were ever spending loads and loads of time going over a stock because something isn't working and it's complex and it might not make a lot of sense for you. The other thing that I would note is throughout financial history, there's been different periods. The business is always evolving, and there's been periods, go back long enough, tobacco was a big industry, and then oil, and then all these different phases. And it's no surprise that we're going through a period of history where a lot of these technology companies are doing really well. So contrary to what some people say about having to find this really obscure idea, I mean, there's some companies that just have that runway and have positioned themselves as leaders. I think Microsoft has been in that position for a while now, since we've owned it. It's reinvented itself. Same with Google. These are stocks of our time that have a lot of runway, and the real trick is just in actually holding them. Now, on the mistakes, and this only took me half a decade to learn, but the importance of aligned interests. And we had an investment in China Mobile, and this is a predominantly state-owned company. They have 70% market share in China in mobile, and we always saw a fantastic pathway in terms of more data usage that should drive earnings, but it was really a conflict of interest problem where the government policies, and even to an extent probably the executives and the pressure they got from governments, they were putting people in the country first, and they had pressure really not to monetize their position like we would see in maybe other parts of that world. And so a stock that from the outside always looked inexpensive, whether it was on a price to earnings multiple or a dividend multiple or any discounted cash flow work that you would do on it, the incentives just didn't line up. And that was a significant error that certainly I made and had to learn the hard way.
Yeah, absolutely. Thank you for those case studies. They're really excellent. Do you have any advice for people who, let's say, are hardwired more to look for, let's say, Graham cigar butt deep value investments, but are trying to move towards looking for, maybe more modern day Buffett investing philosophy, where you're looking for companies with moats and long runways?
Well, I mean, that's a very popular strategy. Here's what I would say, regardless of which way you're looking at, is I think what people have to do as investors is remove yourself from the equation. The stock doesn't know that you're going to own it or not. The stock doesn't care that you're a value investor. You're looking at all the rules of the universe are sort of independent of you. And I think a lot of the mental errors people make is that they, in some way, attach themselves to the idea. They make the idea their own. They think that, well, I am a value investor. I am associated with these stocks. You are completely independent. And I think just freeing yourself of the idea, just saying, you know what, these ideas, these stocks, they are free from me. That can be very powerful, because you can start to look at the world with a lot more indifference, a lot more an objective attitude into figuring out how you should allocate your time. Because there's going to be times where, yeah, there's a mature business that maybe makes a lot of sense, or maybe there's a company that there's some fundamental reason why it should be sold. Maybe it's family control, and with enough time that will happen. It's just a matter of time. But I would say it's very dangerous to prejudge or predisposition yourself into any one category.
Yeah, absolutely. That makes a lot of sense. Let's talk a little bit about Russia. How are you finding? I mean, obviously, a lot of things that are very discounted right now because of the political tensions and what's going on. Are you finding that Are you finding it interesting to look at investment opportunities there right now, or are you sort of saying, this isn't really what's interesting for us?
It's tough to know. It depends how it turns out, right? There's scenarios where maybe nothing comes of this, and that this ends up being a great investment opportunity. And there's scenarios where, I mean, you can imagine being on the eve of the First World War, the Second World War, and if you had doubled down on certain securities in different countries, it would not be a very good idea. There's scenarios out there, even in a moderated scenario, where you are starting to see, we're kind of in the age of almost investor activism, and you'll see governments, maybe the United States, put more restrictions on what securities you can own, can't own. Could all of the European Union say, you shall not, it is illegal to own, I don't know, a direct Russian listed stock? I don't know, but I think we have to think about those probabilities. So again, this is something that we're mirrored with in uncertainty. I think, if you are to be looking at those scenarios or those types of securities, you want to be thinking, well, how can I get exposure in terms of the valuation discount with the least risk possible? And often it's some sort of backdoor exposure or way that maybe isn't so obvious.
Yeah, that makes a lot of sense. Thank you for your comments on that. Can you discuss your thesis a little bit of Momo.com?
Oh, well, this is a security that's really a transition. The bulk of the value is in its e-commerce business in Taiwan, and it's done exceptional in terms of growth, but it's also been a security that we've been cutting back on valuation. So what you'll find, and one of the advantages to being a global investor, is you'll pick up on a business model and kind of get the playbook from it, and you can replicate those mental models, those ideas in other countries. And that's just kind of the e-commerce playbook in Taiwan.
Yeah, that makes a lot of sense. And then another one people were interested in is if you could discuss a little bit your thesis on Novo Nordisk.
Well, here's a pharma company that has focused on diabetes, and so it is much more singular than a lot of the other pharmaceutical companies. With that, you gain scale in their research initiatives, and they've made good strides at sort of improving their product offering, especially in terms of delivery. That's one thing that people maybe understand less about insulin. Sometimes you can be worried about the pricing of it, but there's more value add to be achieved through delivery methods and other options. So there's still lower cost methods, and that's one thing I think you have to get your head around in terms of the investment case. So people are always concerned about pricing. I think there's also upside in terms of what their research and some of their drugs can do for obesity. And if you were to envision how that company could transform some of its initiatives and think 10 years or 15 years in the future, it could be that a lot bigger part of the value that they provide people is actually through programs that are managing obesity. And so that's the way that I would think about that, is much more in terms of optionality.
Yeah, absolutely. That makes a lot of sense as well. And what qualities, backgrounds, or experiences are you looking for in college students who dream of one day working at Mower Investment Management?
Well, I think it's people that have a good business sense. And so you want to be a self-starter and have, arguably have some experience in terms of um, thinking like a business person just as much as thinking as an investor. We believe in a culture of excellence, and what that means to us is always working hard to improve things, sort of persevering to get to the next level. And that's a journey. That's just a character trait that we look for in our people. We believe in teams. And so when we're looking at these investment problems, it's not that we're trying to find people that are the star player necessarily. We want people that fit with our team, that are going to provide a different perspective and be able to communicate and engage in this high performance investment team. We focus on people with both the mental horsepower and temperament. Investment's very funny because if you get too excited about things, temperament-wise, you get too emotional about things, you can make behavioral errors. So your temperament's actually a really important attribute, learning also how to manage that. Math is another one. So not only should you be fairly good with math, you don't have to do calculus in your head, but have enough mathematical sense where you can think about the odds, you can think probabilistically, you can apply math to reality, you can estimate things, have a sense of how math interacts with reality. So those are a few of the traits. I also think in terms of, let's go back to the topic of decision making, if that's really what we're in the business in. So you want to be constantly evaluating yourself. What we look for are people that are open to new ideas and think about different scenarios and aren't getting locked in. If you think you know too much about the world, if you're absolutely sure that something's going to pan out, if you're not listening to someone else's view, those are characteristics that we would want to change and adjust. We're looking for people that are open and are curious and do take in these new probabilities.
Yeah, that sounds great. And we've discussed this a little bit already before regarding moats and globalization. But overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
It's probably a little bit of both. I mean, it's certainly some competitive advantages have declined significantly. It's going to be interesting. The Super Bowl is coming up. I mean, that's a fun one to consider, because imagine in the past where you could just advertise, you had kind of national scale, you could advertise on the radio and TV. There's only a few distribution channels and you're the only one that could afford advertising at the Super Bowl. That world's kind of changed now in terms of the internet and things going viral. You could, you can provide, you can get the message out to people more so than ever before. But people are still stubborn. Don't underestimate that. People still really don't like to change. And when they're used to a process, or, it's tough to get off it. There's, I bet you've used Microsoft Excel. That's something that there's so many switching costs. You get used to using that. I mean, I don't think I could ever change. You just get locked in. So there's some things like that. The other thing that's happened is there's the opportunity for more social networks and sort of development networks that tie things in. A really interesting question is to ask yourself, well, why is it, if there's all this new technology and stuff, why is there only, a couple operating platforms for computers? Why is there only a couple operating systems for cell phones? Why is that? Well, it's because ultimately you get kind of these developing networks that cluster around these ones, And companies don't want to support so many operating systems. It's sort of there's a scale benefit. So once you get that position, I think it's actually very strong. So that's a change to the positive. Probably it's not totally tied in, but I would say that some of the cloud infrastructure, Microsoft's Azure, Amazon's AWS, that has the potential to exhibit the same things if it's not already there in terms of kind of developer network effects.
Yeah, absolutely. That also makes a lot of sense. And can you talk a little bit about diversification? Your thoughts on that, how you diversify portfolio, let's say the number of stocks you typically hold in one of your funds?
Well, it depends on the fund, but typically 40 to 70. So I would consider that, pretty diversified, but not to the point where there's 300 securities or anything like that. I think the more important factor, because you can have lots of securities, but you have to think about, well, are those securities together when they interact in a portfolio, are they going to be resilient under different situations? If you own 60 stocks and they're all internet stocks that price in a lot of the same psychological risk in the stock market, you might be diversified by number, but you won't be resilient in certain situations. So I think that's the thing to think through, and you got to think through second order effects. And imagine rather than COVID, and we're dealing with managing a portfolio under kind of the situation we've had the last couple of years. Imagine if the scenario was that the internet went down. Can you imagine life without the internet? And what would you do to that your portfolio would be resilient in under that situation? I mean, I think that's the puzzling thing about the stock market and the economy is like, there's going to be some new risk, some evolution in how we function as humans that you're not going to know. Your 2008, 2009 financial crisis playbook is not going to work for our COVID scenario. And the next thing, whatever it is, it's not going to work either. So going back to how do you make investment decisions? How do you make decisions under uncertainty? It's a question of building in resilience to, whatever, whether it's a portfolio or just your life in general, thinking through what happens if these different situations pan out. Will you be able to bounce back? Will it be okay?
Yeah, absolutely. And how helpful do you think is an MBA in the investment management industry?
Sorry, say that again.
How helpful do you think an MBA is in the investment management industry?
I think education in general has a very high return on investment. And I think it's also the case that you can learn through many different channels in terms of how to invest. I think MBAs are excellent for connections and lots of leadership, but I don't think it's mandated. It's a nice to have. It's not necessarily a must have. There's lots of different pathways into this industry, and I think it really depends on the individual. My advice is, whether you're going down the path of your CFA or MBA or a master's degree somewhere, or straight into industry, go with where you get positive energy and your heart's taking you.
Yeah, absolutely. That makes a lot of sense. I think it's great advice. What company do you think has the strongest business model today?
I just look at things that I can't imagine without in the world. And the two that comes to mind, I'll ask you the same question. What two businesses could you not live without when you think about your day? But for me, Google's probably the first one, or Alphabet. In terms of search, I can't imagine I use it every day. I can't imagine life without it. And it's such a powerful business because of the network effect, not only of the users, but importantly, the information that they get from it. They're on a wonderful treadmill of accumulating that information and helping people sort out the problem of how to get all this information managed. There's only going to be more information and data in the future, and so this problem gets harder, and they have the pole position there. So that's one. And the other one for me is is Microsoft. That's much more on the business side of things. And of course, they have different products. We all know their operating system and their productivity. But just consider how many, what an advantage they have in terms of the infrastructure, the number of Outlook accounts, the number of operating systems and licenses, what that can do in terms of security, the way our world is moving. With Azure just selling this sort of one-stop shop where everything works together, it's extremely powerful. And that company has really, over the past half decade or so, adjusted that culture to be able to capitalize on the opportunity at hand. So I think that as a business, it'll have its ups and downs in terms of valuation, but as a business, it's in a very powerful position because of all those switching costs and kind of one-stop shop effect that it has going on.
Yeah, that makes a lot of sense. And for a concluding question today, which events have been most influential in your investing career?
Which events? I mean, I approach this question two ways. One is you really don't understand the stock market until you've lived through some sort of major crash, correction, recession. You just can't learn it by reading or talking to people. It's different experiencing it. So certainly seeing what happened in 2008, 2009 was extremely informative, living through that. Same thing with the tech meltdown, 2000, 2001. The other one for me would be living in Singapore, because it starts to open up your eyes about how many biases you have and how there's a different way to do things. If you spend time traveling, living in different countries, I think you gain a better appreciation for being more tolerant, being open, and that translates through into how you invest, how you interact with people, how you think about the world evolving. So travel and go through bear markets.
Sounds great. Excellent. Thank you so much. This is a phenomenal session, and we really appreciate you taking the time out of your busy schedule to speak with us today.
Absolutely. Thank you so much for your time, and I hope this is helpful for everyone that takes the time to view it.
Very helpful. Thank you so much. Have a great day. Bye-bye.
Goodbye.